What if the biggest story in crypto right now isn't Bitcoin? What if the real shift is happening underneath the surface, inside the banking system itself? Because while the S&P 500 just closed at all-time highs, Wall Street is quietly preparing for a world where money moves on-chain. BlackRock is tokenizing money market funds on Ethereum. Banks are lobbying Congress in panic mode over stablecoin yield, and the Crypto Clarity Act is now heading toward a Senate vote. This isn't random anymore. This is the collision between traditional finance and programmable finance. And if you're holding XRP, Ethereum, Bitcoin, or even stablecoins themselves, you need to understand where this is going next, because the market is starting to realize something huge. The infrastructure transition may already be underway. Nothing in this video is financial advice. Always do your own research before making investment decisions. Welcome back to Ledger Pulse, your home for the biggest stories in crypto, macro, markets, and the future of finance. If you've been watching this channel for a while, you already know. The headlines matter, but the incentives behind the headlines matter even more. And right now, the incentives are changing fast. Today, we're breaking down why the stock market hitting record highs matters for crypto, BlackRock's newest Ethereum-based tokenization move, why banks are suddenly terrified of stablecoin yield, what's happening with the Clarity Act vote, and why this entire setup could become one of the biggest liquidity shifts we've seen in years. Let's get into it. So first, let's start with the macro backdrop. The S&P 500 and Nasdaq just recorded their highest daily and weekly closes in history. That's important because despite recession fears, geopolitical tensions, debt concerns, and sticky inflation, capital is flooding into risk assets. And historically, when liquidity expands and confidence returns, crypto doesn't stay quiet for long. Now, obviously, Bitcoin has already been leading this cycle, but what's interesting is what's happening underneath the surface. The market is beginning to rotate toward infrastructure narratives again. Not memes, not hype, infrastructure. Payments, stablecoins, tokenization, settlement rails, on-chain finance. That's where institutions are placing their bets. And that brings us directly to BlackRock. BlackRock is reportedly preparing to launch tokenized money market funds on Ethereum. Read that again carefully. Not a crypto startup, not a DeFi protocol, BlackRock, the largest asset manager on Earth, and they're moving treasury-based liquidity products onto blockchain rails. This is one of the clearest signs yet that tokenization is no longer theoretical, it's operational. Now here's why this matters. Money market funds are traditionally viewed as safe, cash-like instruments, very conservative, very institutional. But BlackRock is now exploring ways to represent those assets digitally, on-chain. Why? Because blockchain infrastructure dramatically improves settlement efficiency, transferability, transparency, programmability, and eventually interoperability between financial systems. This is exactly what many people in crypto have been talking about for years. Not replacing finance, upgrading it. And notice something important here. BlackRock specifically chose Ethereum infrastructure. That doesn't automatically mean ETH explodes tomorrow, but it absolutely reinforces Ethereum's growing role as institutional financial plumbing. And when the world's largest asset manager starts tokenizing traditional assets on-chain, the rest of Wall Street notices. Now this next story might actually be the most important one in the entire episode, because behind the scenes, banks are aggressively lobbying against stablecoin yield provisions in the latest crypto legislation discussions, and that tells you everything. According to reports, banking groups are worried that stablecoin reward systems could compete directly with traditional savings accounts. Think about that. For years, crypto critics said stablecoins were irrelevant. Now, major banking organizations are openly admitting they fear deposits leaving the banking system. This is a massive psychological shift, because stablecoins are no longer being treated like some fringe crypto experiment. They're being viewed as potential competitors to commercial banking products. And honestly, the banks have a point. Imagine a future where dollar stablecoins settle instantly. Users earn yield directly through tokenized treasury exposure. Transfers happen 24/7 globally, and financial applications become programmable. That changes everything, especially for younger generations who already distrust traditional banking systems. Now to be clear, The lobbying pressure does not mean banks are losing. Far from it. In many ways, banks are trying to shape the rules before the industry fully matures. But the fact they're fighting this hard tells you the threat is real, because if tokenized dollars become widely adopted, deposits may slowly migrate toward digital financial rails, and that creates a very different competitive landscape. Now let's talk about the Clarity Act. The Senate Banking Committee is reportedly scheduling an initial vote for Thursday, May 14th. This is huge, because for the first time in a long time, there appears to be serious momentum behind broader crypto market structure legislation. But there's still tension, a lot of tension. Some lawmakers remain concerned about conflicts of interest, stablecoin reward structures, and how digital asset firms could operate under future regulatory frameworks. And according to recent reports, there's disagreement behind closed doors over whether the compromise language around stablecoin yield goes too far. This is where things get fascinating politically, because you're seeing multiple power centers collide at once. Banks, crypto firms, regulators, lawmakers, asset managers, and fintech infrastructure companies. Everybody wants influence over the next financial system. And the reason these debates matter so much is simple. Regulatory clarity unlocks capital. Institutions don't want uncertainty forever. They want frameworks, rules, definitions, pathways. That's when adoption accelerates. So even though the legislation process may still get messy, the direction of travel is becoming increasingly obvious. Washington is moving from should crypto exist to how do we regulate integration. That's a completely different phase of the cycle. Now, naturally, XRP investors are paying close attention to all this, and honestly, it makes sense why. Because if the future financial system becomes increasingly tokenized, then interoperability and settlement infrastructure become incredibly important. That has always been part of the XRP narrative: cross-border liquidity, fast settlement, institutional rails. Now, obviously, there's still debate over exactly how much XRP itself will ultimately be used in future institutional systems, but what's undeniable is this: the world is steadily moving toward blockchain integrated finance. That's no longer speculation. The debate now is about which networks, which assets, and which companies capture value from that transition. Ethereum is clearly gaining traction in tokenization. Stablecoins are becoming systemically important. Bitcoin is being treated increasingly like a macro asset. And XRP continues positioning around liquidity and payments infrastructure. Different lanes, different use cases. But the broader thesis that blockchain becomes part of mainstream finance keeps strengthening. Here's the part most people still don't fully understand. This isn't just about crypto prices anymore. It's about the digitization of financial infrastructure itself. And when you zoom out, everything suddenly connects. Record equity markets, tokenized treasury products, stablecoin regulation, institutional blockchain settlement, bank lobbying, ETF adoption, global debt expansion. These are not isolated stories. They are pieces of the same transition, a transition from legacy financial architecture toward programmable financial architecture. Now, will it happen overnight? Of course not. Will there be setbacks, regulation battles, and volatility? Absolutely. But the direction is becoming harder to ignore, because once institutions discover they can move value faster, cheaper, and more transparently on-chain, there's no logical reason to fully go backwards, and that's why the cycle feels different. Previous cycles were mostly speculation-driven. This one increasingly feels infrastructure-driven. That distinction matters a lot. So here's the big takeaway. Wall Street is no longer asking whether blockchain matters. They're deciding how to integrate it. BlackRock is tokenizing assets, banks are fighting stablecoin incentives, lawmakers are negotiating crypto frameworks, and markets are beginning to price in the possibility that digital financial rails are becoming permanent. That doesn't mean every project succeeds, and it doesn't mean prices only go up. But it does mean the conversation has fundamentally changed, and if that trend continues, the next few years could reshape finance faster than most people expect. If you enjoyed this breakdown, make sure to subscribe, leave a like, and turn on notifications so you don't miss the next episode. And let me know in the comments, which network do you think benefits the most from tokenization and stablecoin adoption? Ethereum, XRP, or Bitcoin? Or something else entirely? Thanks for listening, and we'll catch you in the next one.